Our goal is to break the power of the mob in America and nothing short of it. We mean to end their profits, imprison their members, and cripple their organization. Imprison their members and cripple their organization. Cripple their organization. Imprison their members. Break the power of the mob. Our goal is to break the power of the mob in America and nothing short of it. We mean to end their profits, imprison their members, and cripple their organization.
Few more minutes, folks. Just letting folks roll in.
Imprison their members and cripple their organization. Cripple their organization. Imprison their members. Break the power of the mob.
Hello, hello, hello. What is going on, world? It is I, Alonzo Hall, aka the Blue Blazer, and I have returned today. Today, I want to talk to you about something that I hear often as a financial professional. Well, how much is X amount of dollars worth of life insurance? And I'm going to read with you an article about the average cost of life insurance, and then I'm going to show you why it's impossible to actually ask a financial professional how much life insurance is and get any kind of an answer. Generally, the answer should be between $1 and $1 million a month. And I'll show you why. First, we're going to read this article, however, from the Nerd Wallet. And as you'll notice here, it says, average life insurance rates for 2020. Now, as you notice, it says shopping for life insurance during the pandemic. Be aware that insurers have changed their products and policy applications. For the latest, go to your financial advisor. Now, if you're looking for life insurance, you have dozens of companies, term lengths, and coverage amounts to choose from. Price will no doubt factor into your decision and may even determine what type of policy you choose. To give you a snapshot of those prices, NerdWallet has compared average life insurance rates for men and women at different ages and health tiers across multiple coverage options. So now the average cost of life insurance, they say, is $26 a month. This is based on data provided by Quotacy for a 20-year term life policy, which is the most common term length sold. But life insurance rates can vary dramatically among applicants, insurers, and policy types. So how life insurance rates are determined. Life insurance premiums are based primarily on life expectancy. So many other factors do help determine rates, including gender, age, health, and whether you smoke. In general, the healthier you are, the cheaper your premiums. Insurers typically class applicants using terms like super preferred, preferred, and standard, with super preferred being the healthiest category and generally what gets shown to you in TV advertisements. Insurers then calculate the premiums based on your risk class. Your age can also significantly impact premium costs. That's why it's wise to buy life insurance as early as possible. The longer you wait, the more it will cost. The longer you wait, the more your rates will increase based solely on age. According to the Center for Disease Control and Prevention, life expectancy in the United States is 81.2 years for women and 76.2 years for men. So, women will always pay less for life insurance compared with a man of the same age and health with similar risk factors. Waiting to buy a policy will always be more expensive. For example, consider a 30-year-old who waits 10 years to buy a policy at age 40. A 20-year-old $500,000 term life insurance policy would cost about $100 more per year. By waiting 20 years until age 50 for rates on a 20-year $500,000 term life policy will more than triple. So if you want to pay 3 times the cost of some J's that are already worn, then by all means do so. Average annual cost of life insurance by age and gender. The following life insurance rates are based on $500,000 20-year term life insurance policy for super preferred. Let me tell you, America, 98.9% of you will never get super preferred. Generally, you are going to get standard or lower. Okay, most people, unless they're staunch vegans and athletic, don't get above standard. So it says here, the average rate for a man age 30, $229 a year, $193 a year for a woman, $341 a year for a 40-year-old man, $290 a year for a 40-year-old woman, 842 years for a 50-year-old man, $654 a year for a 50-year-old woman. Okay, now again, this is for a 20-year term. As you see, it says average annual cost of life insurance by policy type. The following life insurance rates are based on a $500,000 policy for super preferred applicants. Age 30, annual rate for men in a 20-year term, we already went, but whole life annual rate for men is about $3,600 a year, while the annual rate for a woman is about $3,200 per year. Again, that's $500,000 whole life policy with a super preferred rating, meaning that you have the health of Superman. Nobody has the health of Superman. Age 40, for a man, it's $5,500 a year. For a woman, about $4,900 a year. Age 50, that same $500,000 policy for a man is $8,500 a year. For a woman is $7,500 a year. And then it says average cost of life insurance by health. The following insurance rates are based on a $500,000 20-year term life policy. And then it'll give you the age for women, 30, super preferred, $193 a year. Remember, health is wealth, so we mean that. Whereas preferred is $232 a year, and standard, which is likely what everyone's going to pay because most people have standard or substandard health, is $355 a year. On that same flip side, a 40-year-old woman, super preferred is $290, preferred is $354, and standard is $523. With a 50-year-old woman, super preferred is $654, preferred is $776, and a standard is $1163 a year. So again, most likely everyone is going to fall in the standard classification. So again, when you ask someone how much is life insurance, you can't just think it's that simple. Now for men, again, super preferred for the 500,000 is $229, $293, and standard $422 a year. At 40, $341, $425, and at standard, which is likely the health you'll have, is $670 a year. At 50, $842, $993, and $1564 per year. Now, I also want you to take into account that everything that these people here at NerdWallet are doing is going to be completely standard, and this is going to be a policy that has no frills. So there's something called riders. Each rider is like an aftermarket part or an additional bell and whistle on a car. So it's an additional feature in your policy that you pay for with a rider. These likely policies are just the insurance and no riders. So they're absolutely the lowest cost possible. Now, the average cost of life insurance by term length. The following life insurance rates are based on a 500,000 term life policy for a 40-year-old applicant in the super preferred class. Okay, and this says for a 10-year term, the average rate for men is about $211, whereas the average rate for women is $193. Again, that's super preferred. 20 years, $341. For women, $290, and a 30-year term, $595, and for women, $480 per year. Again, that's $500,000, 20-year term, based on super preferred. So super preferred, again, means that you have the health of Superman. So your annual life insurance spend per household, per state, you know what, that's not really important. You know, certain states spend more than others on life insurance. I do most of my business in New York. As you can see, a lot of New Yorkers spend a lot. New Jersey happens to have a lot of wealthy New Yorkers. People who are in New York City who are wealthy tend to move to New Jersey. So you're going to get a lot of spend there. And apparently South Dakotans spend a lot on their life insurance as well. Okay. And that's the end of their article. Now, what I want to do is I want to show you how those life insurance rates can actually differ. And the reason I want to show you how those life insurance rates can actually differ is because, yeah, all that sounded nice. Now, let's take a look at, let me share this screen again. Let's take a look at a product illustration. And we're going to go ahead and do the blue blazer. And we're just going to do a regular whole life. Actually, we'll start with a term because we want to compare apples to apples. And I want to show you again the difference. Now I'm just going to rate them all here. We're going to do a 10, 20, and 30. I'm going to do the face of 500,000. Okay, just like that article read. We're going to do annual. And we're going to say that he's a non-tobacco user. So if we preview this, and again, this is a term policy. Okay, let me increase the size of this so you can see that. Now, again, this is standard. So this is for a 35-year-old male. Okay, if he gets a term policy, 10 years, 500,000, it's $370 a year. You get a 20-year, it's $515 a year. And a 30-year, it's $870 a year. Now, people will often ask, well, how come if you're locked in for a longer rate, it's more expensive? Because it's cheaper over the long term. You see, the 10-year policy is only for 10 years. After year 10, you have the option to keep it for year 11. But in year 11, the first year, you pay $270 more in the first year than you did for all of the previous 10 years combined. And the price just increases, but your face amount doesn't. And that's the trick of a term policy. Same thing here with the 20-year, it'll stay 515 until the end of the 20 years, and then the first year you're paying $7,300 a year. And then the same with the 30-year. So at the end of 30 years, if you bought a 10-year term policy and kept renewing it, you paid $158,000. If you did a 20-year term and kept renewing it, you paid $114,000. But if you did a 30-year term and paid the $870, which seems more expensive up front, over the course of 30 years, you only paid $26,000. So again, don't worry about how much the life insurance costs. Worry about what it is that it can do for you. Now, we just did that one with non-tobacco. Let's do that one with a preferred plus or the super preferred, right? So preferred plus. Now, this is standard. This is the preferred plus. Let's see how much cheaper that $500,000 is for the preferred plus. So for the preferred plus, same scenario, but now he's got the superior health. Did I make him a tobacco smoker in that too? No, I did preferred plus. Okay. So in the preferred plus, as you'll notice, it's 205, 290, or 470 versus the same amount of coverage, 370, 515, or 870. So it's almost $400 a year more. And all we did was change the health. Now, let's look at something else. Let's see if he's a tobacco user. Same scenario, right? So it's the same guy, 35-year-old blue blazer, $500,000 policy. Same thing here. Blue blazer, 35 years old, $500,000 policy. They're all term policies. So they're all exactly the same thing. I changed no bells, no whistles. Why is this one not the exact same price as the other one? It's the exact same guy, exact same date of birth, exact same age, height, weight, everything else is the same, but the health is a little bit different. And just for the simple fact that you smoke tobacco, it triples the price. Again, let's look at standard, $370, tobacco, $930. Standard, $515, tobacco, $1370. Standard, $870, tobacco, $2150. Standard, this is super preferred or preferred plus, $205, tobacco, $930. So never ask someone how much a life insurance policy is because it's not an item. It's very much custom to you. It's like asking someone how many licks does it take till you get to the center of a Tootsie Pop? No one will ever know. Now, that is just term policies with 3 different rates of health. I did not do something called riders. If I change riders, okay, you have things like waiver of premium, meaning if you are unable to pay your premium under certain circumstances, the insurance company will pay the premium for you. Now, 2 riders that automatically come are the terminal illness and the conversion extension. The conversion extension will only be a term rider, but you also have the children's rider and the accidental death benefit. The children's rider is the family plan. This is where people put a life insurance policy on their child through their own life insurance policy, but it's not really putting death insurance on your child, because the only benefit to this is your child dies, there's some money to bury them, but it doesn't put money away for them to build. And riders cost, so they eat at the cash value you would build in a policy. Now, in a term policy, there is no cash value, so there's no problem with that. Now, let's look at a permanent policy. Let's look at a whole life policy. And again, let's put in a $500,000 face amount. And let's put a preferred plus non-tobacco user. And let's preview this. Now, this is a whole life policy. So a whole life policy is going to build cash value. So if you look here, this whole life policy for Mr. Blazer, $500,000 policy, it's $5,980 a year. Now, this is with a preferred plus health rating. Okay, so again, let's change that to a non-tobacco, which is standard. Okay, so a standard meaning a regular everyday person who's not got the health of Superman. It's going to be a little more expensive. For that same $500,000 policy for Mr. Blue Blazer, non-tobacco, tobacco. Wait, oh, this is preferred plus. Why is this? Okay, well, in this particular situation, the non-tobacco and the preferred plus are not that drastically different. However, when we add the tobacco, and we're paying annually, yeah, you also get a discount for paying annually. Now, this one being a tobacco user, okay, so both of these, just because you have regular health or superior health, you're going to pay about $6,000 a year. Same policy, same person, but he smokes tobacco. He's going to pay about $8,000 a year for the same policy. So you see how something simple as smoking can drastically change your price. Now, again, I didn't add any bells and whistles yet, but let's take a look at how you can drastically change the price of a policy. So we are going to input the face amount. We're going to input the premium. Okay, now here's what I want you to see, how there's a difference in price. So let's say $200 a month is the premium. And this is let's do the growth. This is a non-tobacco user, and let's preview it. Okay. And if you'll see here, well, $200 a month won't get a tobacco smoker any life insurance. But $299 a month will get a 35-year-old tobacco user a $25,000 life insurance policy. It's almost $300 a month. Why? Because he smokes cigarettes. Now, again, this is for this particular type of policy, which is just a traditional whole life policy. Now, let's make him this is for a non-tobacco smoker. Let's make him a tobacco smoker. And this is just with tobacco. This isn't with other health issues. So as a tobacco smoker, that same $25,000 policy is $397.25 a month, or $400 a month versus $300 a month. So it costs you an extra $100 just because you like to puff. So give up the cigarettes. It's costing you money. Health is wealth. Now, let's take a look at the S class of life insurance policies, which is a universal life or an indexed universal life. Because that's going to be where you're going to see the most change. We'll input the face. Now, we're going to do for cash value accumulation. Now, here's how you can do a difference. Let's say we do the minimum to fund this policy annually. Okay? And this is a tobacco user. We're going to make him preferred plus, so you get the cheapest price possible. Let's close out these two windows and preview. Again, this is a growth index universal life for a 35-year-old man in the state of South Carolina. And the way that we solved for this was the minimum premium. So that means the minimum premium to keep to have the policy. Now, again, people will say they want a cash value policy, but then say, well, that's too expensive, but yet go to a bank account that grows at 0%. So if you do the minimum to fund this policy as a $500,000 policy, $1,800 a month, but looky here, we're not building any cash value. But again, just looking at the price and now the benefit of the policy, which again, as an advisor, we're not salespeople. We ain't here to sell you shit. We're here to advise you. What often too many people do is look at a financial advisor as a salesperson. I'm not here to sell you shit. Yes, I make money off of sales, but I'm not here to sell you shit. So if the tone comes off a certain way, it's because we really don't care. Because at the end of the day, the few $100s that I stand to make off of a sale to you pales in comparison to the hundreds of thousands, yet millions of dollars that you and your family stand to benefit from if you actually take 2 hours to sit down with a financial professional and consider the rest of your life. Just like it takes almost an entire day when you're going into that closing table to close on that home, and all you're doing is bidding yourself guaranteed to pay a debt. Whereas a life insurance policy is bidding yourself guaranteed to receive an income, and not when you die, but during your life. So again, here we see that this policy falls apart because the agent who you sat with just was a salesman and sold you something, not an advisor. So let's look at that same scenario and let's go percent of target. So percent of target means that you have a policy that, unlike this first one, if you'll see here, it's not building any cash value. You're 8 years in and you still have zero cash surrender value. And, after 10 years, you've paid $18,000 into the policy. And if you cancel it, you're only going to get $4,200. But that's because you were worried about how much it costs and not what it would do for you. So now let's look at that same scenario, because I just redid it. And I did it for percent of target. So target premium means that is what it is meant to do to build cash value at minimum and to not fall apart. When I say fall apart, that means that the cash value will run out of the policy and the policy will deplete itself to zero. In the first scenario, and I'll show you that, the policy falls apart. In this scenario, the policy will not fall apart, but you will not gain as much cash value. So again, in prior scenario, this first scenario, right, paying $1,863 a year, your policy is falling apart and you don't have any cash value available to you until the 9th year in the policy. In this scenario, which is just the target premium, you don't get cash value till the 3rd year. Now, you're paying a little bit more because you're paying the target premium. So you're paying $4,800 a year. Now, at the end of 10 years, you've paid in $48,000. But if you cancel the policy, you will get $43,000 back. It's a lot better than $3,100 off of paying in $18,000 for the same $500,000 with an option A in the state of South Carolina for the exact same person. Okay? So again, I'll scroll up so you see that all this information is exactly the same. 500,000, 500,000. Death benefit option A, death benefit option A. State South Carolina, state South Carolina. For the Blue Blazer, age 35, non-tobacco. For the Blue Blazer, age 35, non-tobacco. However, the initial annual premium for the same 500,000 is $1,863 versus $4,815. So the agent can literally make it how much you want to pay. So when you ask someone how much is life insurance, generally I'll ask, well, how much do you want to pay? And then people get upset about that. Ironic. Now, let's leave percent of target and go to maximum. Okay, so this is the maximum funding. And again, this is for the cash value accumulation test. So we're going to preview this one. And this is why I want to show you this, because again, and this is all super preferred health. So again, they're all the same health. You see, I just go right back to it and then I just click preview. The only thing I change may be the health, the target of the premium. Okay. Now this one is meant to maximize your funding. So now this one is a whole lot more expensive. For that same $500,000 a month with death benefit option A in the state of South Carolina for the Blue Blazer age 35 non-tobacco, his annual premium is $15,323.44. However, after 10 years, you've paid in $153,000. After 10 years, you've also got, if you decide to cancel the policy, $33,000 more than you put into it. Okay, as the policy continues to grow, the death benefit grows because you're overfunding the cash. So then let's say you've kept it for 20 years. You paid in $306,000, but you've got almost $250,000 more than you put in. Okay, so let's look further down in these scenarios. Obviously, I don't even need to go down any further because, you know, after 20 years of your policy, with the fall apart scenario, you finally get some cash value. I'm sorry, with the just keep insurance policy, you finally get some cash value. But with the fall apart scenario, when do you get cash value? You don't end up catching up or ever beating your cash value because this policy is designed to fall apart. But again, you're looking at price, not benefit. Insurance is not an item that you're purchasing for price. Insurance is an item that you're purchasing for benefit. Okay, so ladies and gentlemen, that was a little bit of how you can price insurance and the differences in prices of insurance. Remember to like, comment, subscribe, share. Make sure that you visit me on Instagram, Facebook, and please make sure to support the channel so that we can grow and continue to bring you content like this. If you found any value in it, which I'm sure you did, otherwise you wouldn't be here, make sure that you like, comment, subscribe, and tell a friend to tell a friend. With that being said, I'm going to go ahead and check out here. Peace and Black Power. I'm out.
Our goal is to break the power of the mob in America and nothing short of it. We mean to end their profits, imprison their members, and cripple their organizations. Imprison their members